we'll take a look now at a couple more, mostly income statement items, but also kind of some balance sheet items as well. I think my next ones I'll try to flow into maybe cash flow and some of the equity accounts or account. And so the one I'm looking at now is Elf Cosmetics, which again is one that one of the classmates has chosen. And first, I just want to point out, sometimes you'll see some oddball stuff, and this wouldn't be important to report on or put in your final paper necessarily, but it just might kind of surprise you. So I just kind of wanted to point it out. If you come up and you're looking at the selected financial data that ELF puts out, this is of course in their 10K with their annual report. You see this 3 months ended there, a transition period. What happened? Well, they elected to change their year end from December 31st to March 31st. Corporations can pick when they actually want their year to end, for purposes of filing taxes and those types of things. And so they chose March 31st. Good chance that that's because I imagine they're one of those companies that Christmas time is probably extremely busy, the fourth quarter, and so then to wrap everything up and make a year-end financial statement or financial report or a report to the SEC may have been a little bit more difficult, and so to do it in March, that's a little bit of speculation. Again, not important for our paper, but I just wanted to point that out, that you may see some things like that. In this case, then, it's just important to take a look at these 12-month figures, okay, and probably really just discard this 3-month period unless something really strange happened in that 3-month period. Okay, so onward, I kind of wanted to show you something else, and this one I thought was really kind of cool. I gotta scroll down here a bit. Hopefully, I'll find it soon. But in their annual report, and I haven't seen this in too many, they kind of had this, which was the percentage of net sales, which is kind of nice. It kind of keep you from having to do some of the math, right? So it tells you, what's their cost of sales, what their gross profit is, right? 65%, 64%, 61, and how much they're selling general and administrative, and those types of things as a percentage, which I've always said is oftentimes a nice way to look at things. So other than that, I wanted to scroll down. Let me get there. There we go. Let's go look at their annual report in this sense, and this is the income statement. And I wanted to go down. This is again a little bit unusual that they've reported. You come down, you follow along the earnings per share, and back. I think this was maybe it was the first year they went public or something, but in 2016, huge loss. You can kind of ignore that. 2017 was pretty good. 18 though. A decrease. It looked like they've been kind of increasing, and then 2020 perhaps a decrease down to that 13 cents, but up above it says reported normalized diluted earnings per share. Well, I wonder what that is, and this took me some real looking, okay, really took some research and whatnot. And I think too, and I got to speculate because I didn't see it in actual black and white, in their annual report. But what they're saying here is that there were some unusual expenses that occurred in this particular year, which is 2021, most recent year, right, in the trailing 12 months. And those unusual expenses, while they need to report those and whatnot, they kind of wanted to tell you, and that's what this is, what their earnings per share would have been without those unusual expenses. So what were those unusual expenses? And this is the part that really took some research when I went to their annual report. But first let me show you. I could see that where they probably occurred, where those annual expenses probably occurred, because if I look at their gross profit margins, nice and increasing, right? 61, almost 61, bumped up to 64, nice, and even higher in 2021. So it's certainly not their gross profit, it's not their cost of goods sold. But when I come down to operating income and expenses, and again, I did this as a percentage of sales, which was on their annual report, as well, and so you could have seen the same thing. And their expenses jumped from 55.5% to over 61%. That's a big increase in operating expenses, right? As a percent of sales, and so I'm guessing that that's kind of where things fell apart. And so, or it didn't really fall apart, but where they expended that extra money that was the unusual expenses down there. So I came here and I took a look, and again I had to dig through this pretty good. But SG&A expenses were 157 in the year ended March 30, 2020. But that was an increase of nearly 20 million, from the 137.7 the year before. Okay, and what were those? This increase was primarily due to investments in marketing and digital expenses of $17 million. So they added $17 million in expenses, and they thought that was kind of an unusual or one-time type of expense. Okay, and so that's why they did, and this certainly, to my knowledge, would not have been required. I think they probably put that in there just because they wanted to show the shareholders that they think that they're actually doing better than the 13 cents per share, and so they recalculated it and probably added that 17 million or thereabouts. I didn't do the math to see what their actual, or what their earnings per share would have been without that unusual expense. Okay, so an explanation there. There was one other thing I wanted to look at, and this I found a little bit interesting, and that is when I looked at their Goodwill account. It kind of goes back to what I was talking about with SunPower. Their Goodwill account, look at that, it stayed steady, then it jumped up. Okay, I do believe that might have been the purchase of another business. In fact, I'm sure it was. Whoever's doing this one may want to take a look at that. And then here we've got accumulated amortization of goodwill. Most businesses, when they have that goodwill, they tend to write it off or write it down over time as being something that's not of particular value. Certainly not of book value. But when I read through their annual report, I found that. Let me see if I can get down there a little quicker here, and hopefully it won't go past it. Oops. The Goodwill impairment test consists of a comparison. I'll just paraphrase it from now on, but basically what they're saying is that they analyze it every year, and if they don't think that the goodwill has actually gone down in value, they're not going to write it down. And they based that on what the projected cash flows are of that particular element or section or segment of their business, which they purchased at one time, right, and had the goodwill in there. And so because they don't think that it's gone down, they don't write it down. Now, this may be one of those cases too where it differs between the SEC filing that they would report, which you and I get, that's what we look at when we look at the annual report, versus what they report to the IRS. Again, having those two things kind of drives you crazy sometimes if you're comparing the two at times. Fortunately, what we normally see is this SEC filing, but you'll see some adjustments sometimes on these statements that are made because of the IRS reporting that they have to do as well. Gets to be a little bit complicated being a CFO for a big corporation, or even this is a small corporation, but it'd be a good job. It'd be a tough job though too. So that's kind of it. Again, to look at that, I think in my next ones again, I will try to be a little bit more look for the cash flow and look at some equity accounts. There you have it. Have a good day, and I will be talking to you soon.